Hey there, Levinrad over here, and one of the things that really confuses a lot of new real estate investors is understanding the difference between hard money and transactional funding. So I'd like to just clarify and explain to you the difference so you understand them. All right, so let's talk first about hard money. So hard money is simply a private lender like myself lending you money to buy a property. Typically it would be a fix and flip, right? So let's say you want to buy a house for $100,000. I'm going to loan you 90 of it. You're going to put 10 down and I'll loan you the 90. And typically the interest rate on that is going to be higher than a conventional loan. And then the goal would be for you to fix up the property with your own funds and then sell the property and pay the loan off. Or alternatively, fix up the property, put a tenant in place, and then refinance the loan and pay it off, right? So it's a short-term bridge loan. It's not meant to be for anything longer than a short-term period of time. That's why typically hard money loans are with a duration of no more than 1 year. On most fix and flips, you're going to be in and out in less than 6 months, right? So it's a high interest rate loan for a short period of time. It's a bridge loan to bridge a gap so that you can basically get the funds, buy the property, fix it and flip it, pay off the lender and keep the profit, right? Or buy a property, fix it, rent it, refinance it, and pay off the lender. So that's what a hard money loan is. Right now, typically with a hard money loan, the lender is going to be looking for you as a borrower to be a good candidate, right? So what are they going to be looking for? They're going to be looking for, first of all, the property. They're going to want to see that the property is worth a lot more than what you're buying it for. Typically on our loans, we're looking at around 65 to 70% of after repair value. So what that means is if a house is worth, let's say, $100,000, we're going to be comfortable loaning up to around 65 on that specific house. If the house needs a lot of work, a lot of damage, we might adjust that number downwards to 60 or 55, etc., right? That's a hard money loan. The second thing that we're going to be looking for the property is you. In other words, do you have a job? How are you going to be able to make your interest payments to pay us back every month? Do you have money in the bank? So we typically going to ask for a bank statement. We're going to want to see what you do for a living. We're going to see what your credit looks like. If you have a job, if you have decent credit, we're going to have no problem loaning you $90,000 to buy a $100,000 home. We do it every day. In fact, just this morning, we approved a hard money loan for my student Andy, right? So that's what hard money is. Hard money is you borrowing from us or someone else for the purpose of either fixing and flipping or buying, fixing, renting, and refinancing. That's what hard money is. All right, so now we got hard money out of the way. Let's talk about transactional funding. So transactional funding is something completely different to hard money. It's not related in any way, shape, or form. What transactional funding is this. Let's say you make an offer to buy a bank home property for $80,000. And let's say this bank home property is being sold by, for argument's sake, HSBC Bank. Let's say your goal is to wholesale that property. So you sign a contract to buy the property from the bank for $80,000, but your real goal is to flip it to Jack over there for $100,000 and make a $20,000 profit before closing costs. The only problem is you don't have $80,000. So you come to someone like me and you say, hey Lex, I'm buying this property for $80,000. I'm flipping it to Jack over there for $100,000. Can you spot me the $80,000? And I say, sure, if it's in Florida, I'll do it for just 1%. That's $800. And I will wire $80,000 of my money to your title company to pay for the purchase of that house. However, there are a couple of caveats, all right? Meaning exceptions. And what are they? Number one, I'm going to want to see that you have the closing to buy the property at $80,000 at the same title company as the closing to sell it for $100,000. Why? Because that tells me that you'll have less likelihood of there being a problem with the closing. That's number one. Number two, the title company you use has to be approved by us. It has to be a title company that we have a relationship with. Why? Because I don't want to wire my $80,000 to someone I've never heard of because I might not get it back, right? Makes sense. And the third condition is I'm only going to send the wire for $80,000 when Jack has signed his documents to buy it for $100,000 and Jack has wired his $100,000. So I want to see that he's signed and he's paid and both closings are at the same title company, and then I'll gladly wire my $80,000. They'll wire me back my $80,000 a few hours later, plus the $800 fee, and you will walk away with the profit. All right, that's what transactional funding is. The key thing to understand about transactional funding is it's done on the same day. In other words, if you're buying the property from the bank for $80,000 on Monday, you cannot sell it to Jack on a Wednesday because that's not the same day. And that would be a hard money loan. If it's on the same day, then it's transactional funding. You're just using the funds to do a transaction. To make the transaction legal, you're basically taking my wire, paying for it, and now that you own it, you're turning around and selling it to Jack, and you happen to be doing it on the same day. All right, so make sure that you understand the difference between transactional funding or same-day funding for a double closing, and compare that to hard money, which is money that you borrow from a private lender to do a fix and flip or to fix and rent a property. All right, so that's just a little tidbit for you guys. Hope you enjoyed that. Feel free to share this, and I'll see you on the next video.